As we're watching the Fed and interest rates, the markets see a welcome upswing after yesterday's Federal Reserve minutes, giving off a dovish tone going forward. Your thoughts on the Federal Reserve's approach, raising rates? Obviously, that's caused a lot of volatility, but we couldn't have had rates at rock bottom levels for much longer.
This thing happens over and over again. You know, that's the cycle, and that's why I wanted to capture that cycle in the book so people are aware of it. But we're in the later part of the cycle, right? Credit is buying power. You put out credit when you want to create demand. When you then get to later in the cycle, where we are, unemployment rates down and so on, you get a tightening of monetary policy. Then you change the relative returns of asset classes. Like it's 3% across the board. Pretty much you can get 3% without risk now as an interest rate and across the board. So now the comparison of asset prices is different. What will the returns of equities be? All of that slows up and starts to squeeze the capital markets first. As the capital markets start to squeeze, that starts to squeeze the economy. So that's where we are. When we think then how the Federal Reserve will behave, you think about how much buying power it has. Roughly speaking, let's say it's got 3% in the form of interest rates. 3% times the duration, price sensitivity of assets, is essentially what they can do to assets. So let's call that 30%. Maybe they can have, and that's the kind of power that they have. How they're using that power is a very putting on the brakes and stimulating the gas is a delicate exercise. That's why we have recessions. But we're late in the cycle, comparatively late in the cycle, and asset prices are fully priced. And so that's where we are.
So what's your sense of a potential slowdown on the horizon? I mean, that seems to be the issue here, growth. We're worried about growth slowing down. We had 4.2% growth earlier this year in the second quarter, and then 3.5% GDP in the third quarter. Do you worry about a sharp slowdown on the horizon?
There's a hump in the growth that comes from the fiscal stimulation that happened, particularly through the tax cuts, is very stimulative. It also produces a larger deficit. That stimulation comes now, earlier, and produces the hump. And then as you get into next year, then you begin to have that fade, and you have to borrow a lot more money and lend more money to the rest. The rest of the world's got to lend money to you. That situation means that next year you're going to have a significant slowing next year.
And this is really where debt comes in. And I want to talk to you about what you've written here, because the debt that we're talking about on a federal level, $21 trillion, different from corporate debt, different from consumer debt. Markets have not focused on this at all. Recently, I sat down last week on this program with the Bank of Dallas president, Robert Kaplan. Here's what he said about the current government debt rising.
My concern at the government level is increasing debt to GDP is a tailwind right now. We've got a big spending agreement that was made last year. We have a tax reform, tax legislation. All that's providing stimulus. The problem is, in the medium and longer term, that tailwind could turn into a headwind because we're likely going to have to moderate our debt growth.
You've looked back at debt and compared this period back to the 1930s. Tell us about the current situation in debt and how worried you are.
Well, Rob was exactly right? It creates that hump. So we have a lot of debt that has to be sold to the rest of the world, and they're overweighted in holding U.S. denominated debt, and that includes places like China. And so as a result of that, that's a vulnerability. We have that vulnerability, and it is very much like the 1930s. I think what's interesting, bigger picture about the 30s and also the economic cycle, is that from 1929 to 1932, we had a debt crisis in which interest rates hit zero. The same thing happened in our financial crisis. 2008, 2009, we had a debt crisis and interest rates hit zero. As a result, in both of those cases, they had to print a lot of money. And that printing a lot of money bought to buy a lot of financial assets. And that pushed financial asset prices. It also widened the wealth gap. It brought in populism. Populism now and populism then are in many ways an issue around the world. And with that, it produced the economic cycle, the higher asset prices. In 1937, the Federal Reserve started to tighten monetary policy. We have a very similar set of circumstances, analogous. And then we also have this situation of a rising country in the form now of China, then a rising country. And so there are many parallels with the 30s. I think the point is that monetary policy has to be delicate and err on the side, if anything, of accommodating that greater element of growth as we're there. Because if we have a downturn, I think the downturn will be difficult both because of our political confrontations that are existing, domestically in the form of populism, and also internationally. So I think we're in that delicate situation which will be evolving over the next really year and a half.